Easy access to the stock market invited a lot of beginners into the market where bulls and bears are waiting for just one opportunity. We keep on questioning and questioning ourselves, will my shares go up? Will I get rich by this investment? When it comes to investment and the stock market, well, we have a number of ways we try to minimize the risk. We check and double-check PE ratios and whatnot, right? Well, in today's video, we're going to talk about dollar cost averaging, the most beneficial strategy to minimize all the risks as well as your stress. Without wasting any time, let's get started. What is dollar cost averaging? Dollar cost averaging is the practice of investing the same amount of money in a particular stock at regular intervals over a specified time period, regardless of price. In other words, we can easily say that investing the same amount of dollars in the same time intervals by not looking at the share price. It has a lot of benefits which we're going to discuss in detail in this video, but first, let's understand how dollar cost averaging works. Let's try to understand this with a simple example. If you had invested $1,000 in Apple during their IPO on December 12, 1980, today your investment would have been worth more than $400,000. But not all of us are so lucky to pick the right stock at the right time, and given how unpredictable the market is, it gets even more difficult to pick up good stocks. Furthermore, we cannot invest all of our money in the market at the same time. It's too risky and not at all advisable, and this is where dollar cost averaging can help you. Now let's see the same example using dollar cost averaging. Let's say you have the same $1,000, but instead of investing all of it at once, you invest $100 every month. When the market is up, for sure you get lesser shares with $100, but after some time, if you keep on buying the shares in the same pattern, you will observe that the average price of the share is way less than the current market price, giving you significant gain on your investment as compared to investing the whole amount in a lump sum. Now let's take a small hypothetical example for the same. Suppose you have $500 and observe the share price of 5 months. You observe the price of shares is $5 in the first month, $4 in the second, $2 in the third month, and again rises to $4 in the fourth month and reached again at $5 in the fifth month. It is obviously the most beneficial to buy the share in the third month and enjoy the profit in the fifth month. But we cannot time the market. There is no way to know in advance that a particular share will dip in the third month and rise again in the fifth month. And if we invest all $500 in any of the months other than the third, we cannot enjoy much profit. But while using dollar cost averaging, if we invest $100 every month, we can see we have an average cost per share of $3.05, and we have a good profit regardless of any risk. We just saw how dollar cost averaging can help you to get better returns. Now some of you might be thinking, isn't it better to just wait for a stock to hit a new low and invest at that time? Why should we invest every month regardless of the price? Well, this can be true if you are an expert fundamental analyst and know all the factors that fluctuate the price of a stock. But let's agree, guys, if you're watching this video, you are no financial expert. Moreover, there are other benefits of dollar cost averaging as well. Let's discuss each of them in detail. Number 1, habit of investing. But most of the time we spend all of that money on other things and end up losing it all on our temptations and enjoyment by thinking that it is better to buy things instead of risking it. Dollar cost averaging helps us to make a habit of investing while promising a reduction in risks involved. Not just this, but dollar cost averaging helps us develop discipline in investment, as well as we tend to reduce our unfruitful expenses and stick to our investment routine. Number 2, reduction in missing opportunities. Let's understand this by studying the above example again. Suppose we spend all our savings of $500 in the first month itself when the share price was $2. Now you are left with no more money to invest further when the share price reaches its lowest at $2 in the third month. You lose the opportunity to earn a maximum profit because you invested all your money in one go. Dollar cost averaging helps you make a clear decision without missing the opportunities, just like we saw earlier. Again, you never know when the share price is the highest and when is it going to reach its lowest. It is really impossible to buy and sell the shares knowing it all. Dollar cost averaging makes sure that you are ready and are there whenever there's an opportunity to earn more and more. Habit and a proper strategy for investment are much important, and dollar cost averaging is the way. It's always better to earn lesser profits than to expose your money towards the risks of getting greater losses. Number 3. Reduction of stress. We generally get stressed when it comes to our precious savings and are afraid that there can be losses involved. Suppose we invested a large amount of our savings and faced loss. We regret our poor decision and keep on telling ourselves that the investment is of no use and always afraid of losses. But when we practice dollar cost averaging, we invest such a smaller amount of money that it is easily digestible and less regretful whenever there comes a loss or downstream in the market. Furthermore, it makes us fearless when it comes to the market. Dollar cost averaging not only provides a lesser amount of stress, but better decision-making power whenever the stock price falls, because the investor is studying the market for a long time while investing smaller amounts. Number 4. Control your emotional investing. The phenomenon of emotional investing, which is caused by a variety of circumstances such as making a large lump sum investment and loss aversion, is not uncommon in behavioral theory. Emotional investing is eliminated or reduced when using dollar cost averaging. A disciplined buying technique based on dollar cost averaging directs the investor's attention to the work at hand and avoids news and information hype from various media outlets about the stock market's short-term performance and direction. In the end, it is important to note that dollar cost averaging is just a technical and habitual strategy to invest in stocks. It doesn't state that it doesn't involve any risks, but is just a strategy to minimize the risks. There can be losses involved in the dollar cost averaging too, but it just is a proper strategy which comes with low risk and low reward. It is beneficial and advised to practice dollar cost averaging after you have done your research and have learnt enough about investing. This brings us to the end of this video. I hope you were able to learn something new. What strategy do you currently use for your investments? Let us know in the comments section below. Please press the like button, as it helps with the YouTube algorithm and motivate us to make more financial videos like this. Don't forget to subscribe to our channel and click the bell icon so that you never miss another amazing video from us. Till then, stay hungry and keep investing. We will see you in the next one.